a bleak picture that we're actually really at the moment painting, but you look at some of the other data there. For instance, we saw the trade numbers, which are a big blowout. Could this all surprise to the upside?
Well, Rich, I think as you highlighted, the economic surprise numbers and the other numbers that have come out have all been really negative. I think if we're looking for rays of sun, I think social spending was slightly up. Yes, that's social. That's seasonal. You have government issuance also up, which suggests that the government is going to step in to try help cushion this growth. I mean, the Beijing came out and they're still focusing on 6% growth this year. And whilst it's not very aggressive given the current environment, I think they can achieve it. So for us, there's definitely headwinds. It's a change in regime. Property is going to be one of the things that are going to struggle. But there are definitely sectors which are still very interesting in China.
Are the growth concerns in China now becoming a bigger worry than the taper talks coming out of the Fed, Gareth?
I think currently, yes, policy out of China is probably more important than policy out of the U.S. in the current environment. We need to see how the PBOC are going to react. That's why I think these numbers, the big data dump that you highlighted, are going to be so important, because it's going to give real clarity to what COVID has done and what needs to be done if they're going to maintain this stable growth.
Yeah, I was going to ask you about the U.S. inflation numbers as well. I mean, I'm taking a look at vol when it comes to treasuries, and they remain at 3-month lows. Is a strong print from the U.S. on inflation enough to wake up this market right now? What do you think?
Well, you're right. Vol in FX, vol in rates, they're all very low. It's only equity that's pricing in a little bit of this. I think, as you alluded, the biggest risk, the long-term risk, is the idea that inflation remains above target and we get economic recession. Growth comes off. Stagflation. That's a big long-term risk that people are worrying about. I think that is still very far away for developed markets. We think inflation is likely to moderate slightly, but still remain elevated. The pressures are coming from the job markets. You saw in the JOLTS numbers come out last week that it's more of a supply issue that's the problem. Supply of labor. And that's inflationary. You've got commodities, and you've got supply lines. I mean, we heard recently 40-foot containers up 500% from China to Europe. So yeah. I think the transitory argument is struggling.
Yeah, exactly what I was going to come to, actually, because you just got, of course, the supply issues that you alluded to here as well. We've got on top of that these high commodities prices, and on top of that, those PPI numbers out of China would seem to suggest also that we could see China exporting inflation rather than deflation in the past.
Yeah, which again adds to the problem. I think the thing which we're conscious and probably quite positive about is how transparent the central bank in the U.S. has been around this. They've been, really proactive in their engagements of monetary policy, and the biggest risk is they fall behind the curve. So at the moment, we're giving them the benefit of the doubt that they were going to react when numbers move beyond the transitory period. I think it's the composition of the board is very important because, as you know, people's experience to inflation governs their votes. So we're watching how that plays out, how the new governors fit in. The next meeting is going to be very important, albeit we don't think they're going to be announcing anything material.
Gareth, the other question here is about stagflation. Now, are we really at the moment underplaying that, or are investors underplaying the risk of that?
We don't think so. We think that's a risk we're going to be aware of. But probably, if I had to say 25% probability of that happening in developed markets over the next 12 to 18. I think if that even starts showing more signs, aggressively, growth slowdown, inflation still remains high, I think the pain is going to be felt probably first in emerging markets. Emerging markets are facing a lot more woes than they did in the past. They've really leveraged up. They don't have the same sort of growth. They've got a lot of COVID headwinds. So I think the risk is playing out. Developed markets less so than emerging at the moment.
Yeah, Gareth, I wanted to get your call on that. Most people are thinking that we're not going to get a 2013-like taper tantrum for EM. But what exactly are you seeing here, and what sort of taper tantrum are we going to see? Who's going to likely get hit the most, you think?
Well, Yvonne, I think it's clear over the last 12 months that low rates has really opened the door for a lot of economies and emerging markets to really issue huge amounts, records amounts of debt. They've used this Arguably, the growth has been stumbled because of supply constraints, COVID, and all the other challenges that have occurred. So arguably, they're not in as strong a position as as some people expect. We actually think there's a troubled 10. So instead of the old fragile 5, we think there's as many as 10 economies in emerging markets, including my home country, South Africa, that are facing serious headwinds. If taper tantrum or if the Fed normalization occurs and they can't keep up.